Good evening, everyone. I take pleasure in welcoming you all for this webinar. As you know, in general, every month we usually do a webinar with Ashish Somaya, that is our monthly market update, whereby we try and cover what is happening around us, around the world, and we try and pick up a topical subject. This time we have started this new series whereby what we are doing, we want to deep dive into one particular sector. We want to give our audience a flavor of what's happening in that particular sector. What is the how do we foresee that particular sector? What are the things which ideally a partner and advisor should keep in mind? So with that context, we have started this sector series. It would be usually a bi-monthly series, and in this first particular series we are starting with the banking and financial sector. So I'm Nitin Nahar. I head the business development, and we have the pleasure of having Trupti Agrawal with us today. She's expert on the banking and financial sector. She is the fund manager for BFS fund also. Trupti has more than 16 years of experience into this particular field. She's a chartered accountant by profession. Before WhiteOak, she was working with L&T Infrastructure, Ernst& Young. She had a brief stint as an entrepreneur also, so she understands that side of the business as well. So we would like Trupti to take us through your views on this particular sector. There is a lot of uncertainty in people's mind. After the Trump tariff, people have started looking more domestic themed business. So how does BFSI fit in? What is the valuation of this particular sector? Do you think it's one of the thematic funds, or do you think there would be a long-term growth in this sector? So, without further ado, if you can take us through the presentation, Trupti, and later on we can open it for the Q&A. Thank you.
Yeah, hi everyone. Good evening. Thank you so much for being our audience today evening. So let me just start with like precisely I think a little over 1 year back we launched our first set of thematic funds. We had launched the banking and financial services and the healthcare fund, and I'm extremely happy to share with you that both the funds have done exceptionally well. The 1 year, performance of both the funds have been upwards of 20% plus. Those have been the 1 year returns. I just want to highlight that, when we started our first set of thematic funds, our idea of launching a thematic fund was that, we wanted to pursue opportunities in the Indian context, which are structural in nature. We did not want to chase any sectors or any themes which are flavor of the market at any point in time. And this is what actually, this is what happens, right? That every time in the market, there is either like there are a bunch of themes or particular sectors which do very well. And, many times, many of the managers basically launch a theme based on, let's say, the flavor of the market. And more often than not, the funds get launched after the theme or the sector has done well. And unfortunately, many times investors don't have a great experience. So our thought was that, we basically wanted to launch sector funds which would be based on themes which can be multi-decadal opportunities in India, and not something which could just play out over a short period of time. And with this thought, as you would all appreciate that for a developing country like ours, which is on the path of becoming a superpower, the importance of financial services cannot be undermined. So financial services is extremely essential. It touches all the walks of life of an economy. And this, in our opinion, is a long-term structural theme in India because there is significant underpenetration of financial services in India. And financial services typically are a multiplier of GDP. So while we believe that, India is expected to grow at, let's say, early double digits in nominal terms for several years to come, and that is why all of us are so bullish on the India story, financial services would be a multiplier of it. The financial services industry would grow at a multiplier of GDP. And within that, we believe that there are players which actually have the potential to grow substantially higher than the industry, take market share and grow very profitably, creating a lot of wealth for let's say the stakeholders. So on that thought is where we launched the banking and financial services, and as I said, the healthcare funds. And in some sense, we were proven right, because healthcare obviously is perennial story. So is banking and financial services, but the advantage was banking and financial services in the last, let's say, 1 or 2 years, which I'm sure all of you would appreciate, is that the sector was a laggard up till 6 months back, and with every passing year, the valuations were only getting attractive. So we were very convinced that there is no disruption in the long-term story. There are some, let's say, factors at play which were affecting the performance of this sector. But in the last 6 months, when we've seen that post-September, when the market has been weak, banking and financial services has already started outperforming. So, like a lot of people have this misconception that when in the diversified schemes, you have some of the top banks as your exposures, then what is really the use of or need to invest in a sector fund, a specialized banking and financial services fund? So I just want to put out the lay of the land, where I just want to tell the audience that banking and financial services is no longer only about, let's say, HDFC Bank or ICICI Bank, maybe, the top two private banks or an SBI. The sector has actually come of age in India, where it's become very broad, heterogeneous. There are multiple businesses within this industry, and while they're broadly called the financial services, they may not actually have a lot of correlation with each other. The factors or the events which affect lending businesses, like that of a bank or an NBFC, may not impact, let's say, the capital market businesses. And that is what we saw last year, where in the first half of last year, lending businesses, especially banks, were underperforming, but capital markets were very strong. And in the second half, the capital markets, cracked up, and the lending financials basically came back. And hence, the point to understand is that in Indian context, we have like a large variety of businesses, which are lending institutions like banks, and within banks, there are, let's say, not only the frontline, let's say, commercial banks. You also have a category called small finance banks. There are about 8 or 9 small finance banks which are listed in India. You have payment banks. There are NBFCs. NBFCs are identifying and exploiting new niches. There are NBFCs, traditionally in India, we've seen vehicles, gold, finance, mortgages that used to get financed. And now you have NBFCs by way of fintechs. You have affordable housing companies, so on and so forth. When it comes to, let's say, the non-lending financials, as we call them, there are insurance companies. There are quite a few life insurance, general insurance, health insurance companies that are listed in India and yet getting listed. And there are a whole lot of capital market players. So besides the market infrastructure participants like exchanges or depositories, you have a lot of facilitators. You have, let's say, wealth managers, distributors. Many of you are, let's say, for example, distributors. You have very scaled up distributors which have listed in India. An example could be like a Prudent, for example. And then you have RTAs, which I'm sure all of you are dealing with on an ongoing basis when you interact with AMCs like us. So there are all of these which actually form part of this sector. And hence, we should just appreciate that it is no longer just about banks. There are a lot of companies. Many of them are they've opened their eyes in the Indian context, just scratched the surface. Lot of opportunity, lot of runway for growth ahead of them. And many of them are going to be hopefully the winners and large wealth creators of tomorrow. We feel that, banking and financial services is extremely underpenetrated in India. And the data, if you look at it in front of your screen, on your screen, be it, credit or, let's say, mutual fund investments, or the, life insurance coverage, let's say the protection or the term life as it was called, or let's say the general insurance coverage that Indians have, versus the developed world, we definitely are dwarfed with the kind of penetration that the developed world has seen on these financial products versus some of our emerging market countries or the peers. Even on those parameters, on several of these, we are quite underpenetrated. So, financial services is a very, very long-term opportunity in India. And, we think that there should be sufficient growth for several years to come in this sector. India on a global stage has actually gained recognition because of some extraordinary work that has happened on, let's say, building the public digital infrastructure. So we are one of those countries which has been extremely successful on digitizing payments. And I'm sure that I don't need to really talk to a lot about it, because all of us are experiencing it as use cases in India, where the trinity of, let's say, Jandhan program, which was one of the largest drives of financial inclusion to get a lot of population into the banking ambit, coupled with Aadhaar, which has made, let's say, things like KYC, account opening, all of these things, at a click of a button in a fraction of a cost. And then you have on top of it the UPI. Obviously, the telcos, lot of credit to the good work that has been done by Jio, which made, internet extremely cheap in India. All of this have come together very nicely in India. And COVID was one such event which gave a lot of fillip to digital, let's say, economy, be it e-commerce, be it payments, be it stock market trading. This was in some sense an inflection point where all of this has come in, together very nicely. And now, after like so many years, we are actually able to see the good impact of all of these things. So to just give you an example, most of the banks, if any of you follow the banking results, now we see a very, very solid growth in business banking. And most of the banks, frontline banks, are calling business banking or lending to SMEs and MSMEs as the new retail segment in India. This is actually showing a lot of promise. Banks are growing 20-30% in, this business. And one of the reasons that this is actually becoming possible in India is because there is now very rich GST data. After, let's say, the formalization of the economy in 2016 with demonetization and GST in 2018, with good 6-7 years of data, uh, many of these businesses which were, in, let's say, earlier avatars, they were not really bankable, or the banks were not very comfortable lending to these businesses because there was a lot of underreporting of, let's say, maybe the true business income, or there was lack of data on these entities. All of this is now available to banks, and they are actually able to leverage this, and they've identified very good opportunity to lend to this sector. So this is one example when everybody, I think, talks about LPG, which is liberalization, privatization, and globalization that happened in India in the 91. In my opinion, 2016 and 2018 and 2020, these 3 years will be reckoned again as very historic years in Indian context, where these have actually, laid the foundation for formalization of the economy and opened up lot of new avenues of financialization, be it of credit, be it of savings in the Indian context. What is also very interesting in India is that you have an industry where not only is the industry growing very well and it has a very good prospect of growth in the future, you have an industry structure where there are some players in the industry which still have a very dominant market share. And these entities, they are basically not really able to deliver up to the mark. And they are donating, if I may call it, donating market share to some of the more efficient players. So let's say the most of the SOE entities, they basically have multiple objectives. They cater to the needs of multiple stakeholders. And in the process, sometimes they actually tend to be a little inefficient from a capitalistic economy perspective. And hence, sometimes, it almost boils down to government sometimes doesn't have a business to be in business. And this creates an opportunity for the private sector players to take market share from them and grow at rates which are higher than the industry. So be it lending by way of, let's say, banking, where almost 50, more than half of the industry is still owned by PSU banks, as in, when I mean owned, I mean the deposit market share, the advances market shares are still a reasonable part owned by the PSUs. In case of life insurance, there's a very dominant PSU player with a very hefty 40% market share. The general insurance PSUs, there are a 35% market share. And while these companies have definitely made good progress from where they are and upgraded themselves into with technology and all their processes, but versus their private sector peers, I think they still lag, a lot of, let's say, their performance. And hence, the private sector players are very comfortably able to take market share from them and grow faster. I would like to spend, a little bit time on, let's say, one of the very unique things or very strong things about Indian economy, which is our regulatory framework. We have extremely independent and a very, let's say, robust set of regulators which are governing our financial services. And this has actually provided a lot of credibility to the sector because, as you would all appreciate, it's an extremely regulated sector and quite a risky sector. And with very good, let's say, regulators in place, I think India has our regulatory framework and our systems and processes at a economy level are almost compared or are comparable with some of the, let's say, leading developing countries in the world. To give you, let's say, a small example, this year I have just put down, let's say, some of the events, and I'm sure many of you have read about them in the press. Regulator was extremely vigilant, and there were companies, very leading top-notch companies, like the second largest public sector bank, which is Bank of Baroda, the largest NBFC, Bajaj Finance, one of the large private sector banks, Kotak, Mahindra Bank. They were just asked to just stop their business, in, like, let's say, certain segments where the regulator felt that it was not, their processes were not up to the mark. So it almost happens that when a regulator is, let's say, strict or tight with a few players, that's enough to send out a very strong message to the rest of the industry, and that ensures broad-based compliance by all the players. I would credit RBI with with the way they've completely managed to avoid, let's say, a full-blown credit cycle in India. We almost had like a mini credit cycle, asset quality cycle, if I may call, in the unsecured retail. But RBI was much ahead of its time, and they did all that they could do in terms of tightening the risk weights and multiple other measures that they took. And we, I think, as an economy, just again avoided like a full-blown credit cycle, which we had last seen in the retail segment in 2008, 2009. Here is a chart where I wanted to highlight that our economy is one of the only economies which came out of COVID at a leverage which was lower than where we were pre-pandemic. So just to make it simple for everybody to understand, we are talking about leverage, which is the amount of debt that, let's say, the entire system, the banking system has versus the equity that they carry. So that ratio is called the leverage. And if you see the chart, the green bars represent the leverage post-COVID. And India has the distinction of being the country which came out of the COVID with lower leverage than what it went into the pandemic or prior to the pandemic. So in 2019, our leverage was at 11.2 at a system level. And we managed to bring down our leverage, which is extraordinary, because if you look at most of the economies actually ended up either at the same level of leverage, or many of them had significantly increased their leverage. And our economy and our government basically, and the regulator, took enough security measures to tighten the risk management of the entire system. where they made banks to raise money, do QIPs, strengthen their balance sheets. We also did not, as an economy, dole out, let's say, a lot of freebies during the pandemic. And that helped us come out of the system, come out of the pandemic as a safer and a more risk managed economy versus, let's say, most other global economies. Like a lot of you would have had this question and concern that banking and financial services was a very lackluster sector in, let's say, 6 months earlier. For 4 years, there were very, very poor returns from the sector. So is it broken as a theme in India? Is it a structural problem? Maybe like people who do not understand a lot of internal details, maybe they must be probably guessing that there is some problem at a system level, and hence market is not really rewarding these companies. Here is a chart to just show you that, be it parameters like growth, which is measured by loan and deposit growth, we are still tracking a very healthy double-digit growth. Obviously, we were doing much better last year. And as I said, RBI did tighten some of the credit filters or some of the norms to, slow down credit a little bit in the country, because credit was growing at 15-16%. So they wanted to just rein it. And now we are growing at, between, let's say, 11 to 12%, which is actually a very, very attractive number, so to speak. In terms of margins and, let's say, ROA, which captures the entire profitability of the banks, if you look at the charts on the screen, the ROAs and the margins are again tracking very well. I think the best way to think about it is look at a period of 16, 17, 18, where the economy was coming out of a huge corporate asset quality cycle with lot of NPAs in the power sector, with demon, GST. So at that time, if you look at the performance, the graph just tells you that, we had hit like a rock bottom. And from there, if you look at the most recent quarters, again, the performance has been very good in terms of margins as well as profitability. Credit cost, which is an extremely important metric to, test or to know the, let's say, health of these companies, the banking system. We are talking about credit, let's say, costs, which are near to, let's say, 2010-11 years. We as an economy had peaked in terms of credit costs again in that same time frame. So we are not in any kind of an asset quality problem. And the right-hand chart talks about the system coverage ratio, which is nothing but what is the amount of provisions that the banks are carrying against the bad loans. So if you see, that number is at a historic high of 77%. So we are very well provided for, even in terms of our, let's say, NPAs. And just on a last point on this aspect is that corporate India, all the top companies in India, they are again sitting at a very low level of debt equity ratio. This number, if you look at 2015, when we had a power sector, let's say, boom, and then a big asset quality problem, this had almost reached 1 times. It is half from there, which means that there is no stress even in corporate India. Corporate India's balance sheet is also very, very comfortably placed. Now, with these slides, I just wanted to give you a sense of the kind of opportunity that is there ahead of us, as well as the health of the sector. And in both these things, I think the sector is ticking well. Now, this, from here, I just want to talk to you about, let's say, the relative performance of this index. It has been one of the largest wealth creators in India. It is more than 30% or nearly 30% of the index. And if you look at the long-term performance of the financial services index, it has very comfortably outperformed the broader market represented by Nifty 50 and Nifty 500 by almost 300 basis points. So this has been the performance. But it was only after, let's say, 2020 that this sector started underperforming. But now in the last 6 months, if you just pay a little attention to the extreme corner of the graph, the orange bar is now showing you a higher outperformance versus the bottom two gray and blue bar, which just tells you that now financial services has finally started outperforming the broader market. If one looks at, let's say, the kind of returns the sector has given, So in this period from 2004 to 25, the sector has given 71% of the time, the returns have been equal to or more than 15%. And almost 99% of the times, the performance, this sector has given a 10% return. So it has been an extremely attractive sector from the Indian context historically. And we still think that, the thesis is not broken, the opportunity is still there. And we would obviously very difficult to extrapolate and say what would happen in the future, but reasonable to assume that at least all the ingredients for success are still there, and nothing which tells us that returns should underperform the broader market. So I've been again like harping on this point that last 4 years. So for the benefit of the audience, you can look at, let's say, annual performance of Nifty 50, 500 and the financial services. And most of the years, barring, let's say, a GFC in 2008, or let's say a taper tantrum in 2013, if you exclude those kind of international events, which obviously affected the sector used to always outperform the broader market. And then 20 onwards, there was this weakness. And, for good 4 years, let's say the financial services index was giving returns which were lower than the broader market. But the good news now is if we look at the year-to-date performance, we are almost like 5 months into the year. Financial services has again outperformed by almost 10 percentage points with a positive return of 6.7%, whereas the broader market is at minus 4.4. So here, we've just tried to capture that difference, which is the outperformance of, let's say, the broader market and the financial services sector. And as I've been telling you that there was some underperformance, and hence this graph was going, let's say, below zero in the last 4 years. But the last time that it went below zero was during the financial crisis. So I just want the audience to understand that the situation and the environment around us is nowhere close to what happened in GFC. Actually, it is just, a right time. It is an excellent time to basically probably invest in this sector now because it has been underperforming because of some company specific issues. The broader, let's say, the opportunity and the environment is very good. There is no challenge. Some of the issues, I think some of us are aware that one large banks, underwent some corporate event where they were trying to merge with another very large group company. There were some CEO changes in some of the key, let's say, financial institutions. So this obviously creates uncertainty. Plus, COVID was an extremely uncertain time where banks could have gone bankrupt. After COVID, people thought that fintechs would rule the world. So all of these things basically caused that underperformance. But most of these things are behind us. All these issues that I just spoke about, they are all behind us. And hopefully now the tide should finally turn. And valuations, like even after this recent, let's say, rally, the valuations for most of the key parts of the market, like the private banks or the PSU banks, the NBFCs, these are close to their historical averages. In case of PSUs, as many of you would be aware, they had a very, very sharp run last year. So their valuations have, crossed the averages. But if you look at private banks and private NBFCs, they are still at their, so private banks especially are at their, let's say, long-term averages. So the valuations are very reasonable. And the good part of investing in any sector when the valuations are reasonable is it just provides you margin of safety. I obviously do not know when this would turn and finally very, very good returns sustainably would come from the sector. But I do know that if I invest at a time when the valuations are not very stretched, I, allow myself some more time and some more, let's say, time correction and some margin of safety. Very quickly, I just want to talk about WhiteOak's approach. There are 18 banking and financial services funds in India. So what's really so unique and special about us? What do we do differently? We have a time-tested investment philosophy which we strictly follow. And the two important tenets of this philosophy are that we are extremely focused on identifying great businesses. We are not top-down investors. We don't take macro bets. We believe in bottom-up stock selection. So we spend disproportionate time in understanding business models and quality of businesses, and a lot of time on understanding who the managers of these businesses are and whether they are worthy, both in terms of integrity and, let's say, their intellect or their capability, to be our to partner with. And these businesses, whenever we find these businesses, again, valuation is an extremely important criteria. So we want to look at, we have our own valuation framework. We spend a lot of time in looking at attractiveness of, let's say, these opportunities versus their peers, and picking those companies which has the highest upside. This is basically our valuation framework. It's called the OPCO FinCo framework. I'll not go into the details of it because there's a lot of video and material available. If any of you are interested, our founder, Mr. Prashant Khemka, has himself explained this in a lot of detail in some podcasts and also some videos, webinars on our website. So you can please go through it. But I just wanted to, show you with an example how we look at things from a valuation standpoint, which can be a little different from how people conventionally look at, valuations in the sector. So here is an example of, let's say, two lending institutions. These are two banks. These are actually real examples. I've just changed the names. One of them is a very strong bank. Let me call it like a private sector bank. The other bank is, not such a strong bank. It is, let's say, a state-run bank. When people look at, let's say, valuations, people focus on price to book multiple. And if you look at the well-run bank, it's trading at 2.5 times, whereas SOE bank is running at trading at 0.5 times. So the private bank is trading at a 400% premium. And one can argue that banking is a very commoditized business. So why should one give so much of a premium to a private bank? And on that argument, people might find, let's say, the PSU bank very attractive and, just invest in it. The way we think about it is that the price to book multiple is just one part of the things, and it's not a very holistic way of looking at things. What price to book does not capture is the risk in the business, and the risk is denoted by the extent of leverage. So if you look at the leverage, which is for every 1 unit of equity, how much of debt does this, or, debt meaning borrowing plus deposits that the bank carries. So in case of a private bank, that number is 8.3, which means it carries a lower amount of debt for the same level of equity. In case of a PSU, it is almost 10 times. For every 1 rupee of equity, there is about 10 rupees of debt. So this multiple, because it is a ratio between the market capital, market capitalization plus the and the net worth, it does not take into account the leverage of the bank. So it completely misses out on the, let's say, the risk. So what we do is, let's say, if we adjust for it, you will see, and if we bring the borrowings into picture, the private bank will actually be at a multiple of 1.18, which is just 24-25% higher than that of a private bank. And if I were to then pose the question to, let's say, the buyer, that for, let's say, a company which is going to grow much faster, which is where the interests are completely aligned with you, it is going to invest in the best in class technology and talent, would you not want to pay a 25% premium? Would you not be okay with that? I'm sure the answer would be in an affirmative. So it just tells you that, if you look at the banks on the PB multiple, you could probably reach to a wrong conclusion. But if you make that right adjustment to capture the risk as well as the franchise value of the banks, you would use another multiple, which is what we tend to use, and then we reach to a very different conclusion. Just a last few things on WhiteOak's differentiation is that we have a very large coverage universe. It's a very large 6-member banking and financial services team, which is looking at 140 stocks. We look at all stocks which are which have a market cap of more than 1,000 crores. So that's a very large coverage, and it is spread across all the different businesses that I was talking about. So even if a particular business in financial services has zero weight in the index, or a very small weight, the team is still spending time on looking at the companies in that, because these we think can be the alpha creating opportunities for us. We've invested in a very large team which comprises of a lot of senior members, people with global exposure. We have a mix of talent, both in terms of experience and backgrounds. Idea for us is to go very deep into what we do, and also cast our net very wide, so that we can look at pockets of the market which are under researched and create alpha for the fund. So at any point, we look at 140 companies, of which we think 40 to 60 of them are great businesses which are investable. And in the portfolio, there would be between 25 to 35 names, which I think is, again, very unique to us. So these are some of our top holdings. You would see we have a very good representation from a diverse set of businesses. There are lending financials, there is an RTA, there are affordable housing companies, gold financiers, insurance companies, certain holdcos. There are special opportunities to participate. There is a rating agency in the fund, so on and so forth. We have fintechs in the fund. So a lot of basically diverse set of businesses that we've tried to invest in. The banking index is heavily skewed towards the large cap, which is almost makes up for 96.5% of the index. But at WhiteOak, we generally tend to be a little overweight on the SMID part of the market. Not because we believe that SMIDs would outperform the large cap. That is not the view. The reason we like to take certain, let's say, overweight on the SMID part of the market is because this is the part of the market where we believe it is not very well researched, and this would have a lot of interesting opportunities which can create alpha. So just as parting thought, the firm strongly believes in having products which can be long term, which can be aligned to investors on a long term basis, and can be structural stories instead of just chasing some themes in the market. We actively we try to run a very high active share. At this point in time, the active share is close to 31%, because we are seeing, let's say, opportunity in some of the larger banks which dominate the index. But at any point, the endeavor is to run large active shares. We invest in a wide variety of businesses. The team is extremely well resourced. And I would also like you to know that as a matter of policy, we are not, as a team, allowed to invest in stocks directly. We are not allowed to invest in even mutual funds of our peers. So we, clearly, basically eat what we cook first before serving it to our investors. This, I think, creates a lot of alignment between us and our investors. So on that note, maybe I'll take a pause here, and I'm very happy to take questions now.
Sure, Trupti. Thank you so much. It was pretty informative. I'm sure people would have got a sense, how do we run the WhiteOak Banking and Financial Service Fund? What is the outlook of the sector? There are quite a few questions which have come in. I think many of has already been answered, but still, I will repeat that. First question is basically that BFSI funds typically have higher allocation, 25 to 35% in two major banks. How is your fund different than others? So I think you have already covered, Trupti, whereby you have said that the mid and small exposure is 15-16% in our case, and there are 20-25 names which are in mid and small space or in the entire portfolio, which may be unique to the other AMCs. Any other thought you have
Yeah, I'll
when you
probably
compare?
just, share a point here. So at this stage, again, the top two banks are a large part of the portfolio. But, I just want to, tell the audience that the whole point of an active share is not to have it for the sake of it. The team strongly believes that, all the names that we have in the portfolio, these are the companies at this point in time. They are showing us the highest potential in terms of upside. And so there would be points in time where, let's say, I mean, as it is today, that these two banks are the top two names in the portfolio, because these are very attractive in terms of their valuations today. But nothing, binds us to have them this way. There could be a point in the cycle where maybe some other names actually become a lot more attractive, and there is a very strong possibility that we may not have the same kind of weight that we have here. As a risk management practice, we have decided not to have significant deviation from the benchmark, and the reason is to have some kind of a consistency in our returns. So if these two banks actually are close to 40 to 50% of the index, close to 50% of the index. So obviously, it would be unlikely that we would probably run a very, very significant deviation from the benchmark. But once they achieve their price targets and there are other opportunities which are more compelling, we could definitely have a more underweight. And even as we speak today, HDFC Bank, which is almost 32% of the fund, of the index, we are still quite underweight, and we are running it at 18% weight. So we are almost 14% underweight HDFC Bank versus the benchmark.
Sure. Thanks, Trupti. There's one question on bank versus AMC's NBFC sector, that with the deposits coming down because of more of MF penetration, credit is going down, growth going down. BFSI sector certainly gives opportunity in AMC, insurance, AMC, NBFC business. What do you think about the banks per se? Where the banks will go from here with the deposit going down, courtesy mutual funds?
So see, one of the big myths that people have is that the deposit problem in India has happened because of the mutual fund. So what I think all of us should understand is that when you are giving us money to invest, you're not giving us cash, right? You are giving it in some banking form. You're either giving us a check or a draft, or doing a, let's say, a bank mandate.
Yes.
So the money is within the banking system. Even if the investments are going in mutual fund, money is not going out of the banking system. Only thing that is happening is that money which was lying in maybe savings account, which was dumb money, and people used to keep it out of inertia. Now it is becoming smart, where people are saying that I don't want 3.5%. I'll rather take like a 7-8% maybe in a liquid fund, or a little more in. So money is becoming, it's just moving from, let's say, CASA, which was the most attractive part for any bank, to other forms of deposits. So what one needs to understand, that mutual fund is not taking away bank deposits. It is just changing the form. Now, what happens is that banks are a margin business. Money is the raw material for them. And whatever is the cost of money, they are going to load a margin on it and give it to their borrower. So if the deposit which was costing them 3.5% is now going to cost them 5%, the cost of that is going to be borne by their borrowers. So the bank is going to keep the same margin which it used to keep when the money was 3.5% or 5%. And also one needs to appreciate is that these banks, by virtue of their scale and size, they are actually now enjoying benefits of operating leverage. They have spent so much money on creating these companies and franchises that now they don't need to spend the same kind of money. So even if they will lose a little bit on the margin, they will compensate it by lower OPEX and still deliver to you a very healthy double digit, and that to a close to a, let's say, I'm talking about not even mid-teens, between 15 to 20% kind of a ROE is something that even these large banks can generate for a long period of time, is what we believe. So we are extremely constructive on the banking sector, and banking is one sector where the big becomes bigger. The incumbents actually have a huge advantage because it's a very regulated sector. It is not like your quick commerce where everybody can go and open their dark stores. It is a sector which is governed by license, and all of you would know that RBI is not very generous in giving licenses. So the people who already have that license and the brand and the franchise are at a huge advantage, and hence we are very, very positive on banks even in the years to come.
Sure. Thanks, Trupti. couple of questions on people who have seen the portfolio and they are asking, what about calls on AMC business which are rapidly going, but they can't find any AMC name or maybe a mutual fund distributor, the listed distributor. So any
Sure.
thoughts on that?
Yeah. So, see, we are extremely bullish on the AMC industry, and that is the reason why we are also into this business and building WhiteOak, right? So, AMC definitely has a very, very long runway for growth in India. India is where US was, let's say, in early 90s, and then we've seen where US has gone. So, obviously, we are also expecting that India would take that trajectory. The way we participate in AMC, see, one way is that you can directly participate in the business that you like, and another way is that you can participate it through the people, the service providers who are catering to that industry. And we believe in the latter because it's something like, it's a pipe, and it doesn't matter whether there is water or liquid or petrol that is going to go through that pipe. The pipe is going to earn its rental, right? So AMCs can lose market share depending on their performance, etc. But the service providers will continue to be in business. And hence, in the fund, you would see that we've invested in an RTA. At various points in time, we had invested in distributors and wealth managers. But then these are very dynamic calls. And every time, let's say the relative outperformance or whenever we see that there is better opportunity or the capital can be deployed in a better manner to generate more upside, we just replace those names. So we did own distributors for some point for the same logic that they are service providers to the AMC industry. But at this stage, yeah, we own an RTA in the fund.
Sure, that answers that. One question, Tutti, we have that, while advisors and distributors already make a portfolio of a client into large, mid, small, and these kind of funds, which are already overweight on financial. Generally, by and large, everybody is overweight on financials. Does it make sense to go for a thematic fund, financial sector fund in this case?
Sure. So see, even like as I speak at WhiteOak, we run so many diversified schemes. And since I'm a part of the banking and financial services, we are, providing inputs on the kind of stocks that we should take in the diversified scheme. See, each of these schemes have a different mandate. They have a different benchmark, and there is a different, its own set of expectations from that product. So there is a possibility, and if some of you are really interested in this, then you should look at the kind of names that we own in the BFSI fund versus what we own in the diversified schemes in the financial sector. There are a lot of times when there are differences because, the objective of a banking and financial services sector fund is very different. And in the diversified schemes, your choice could be very different. So I would, one, recommend that I think, as I said, what makes this particular theme extremely attractive at this point in time is that the valuations are very favorable. So even if there is, let's say, reasonable allocation to this sector in the diversified schemes, you are still investing in a sector which is very attractively valued. So you would have different set of names. It is managed differently because, as I said, the index is different, the composition is different, the names are different, and there is comfort of valuations. So at this point in time, having this fund, I think it would be a good idea. Once, let's say, the valuations, when let's say there is some price performance, I think you can revisit it at that time. But given that this is a multi-decade opportunity, lot of companies yet to be listed in India, and many of them in financial services sector. So this would constantly have new ideas, and this sector will always be full of action.
One question kind of related to this is generally it is meant that BFSI is a cyclical theme, goes more up and down with the economy and highly sensitive to cycles also. Then why do we claim that it can be a structural opportunity on a long-term basis to invest into a thematic fund like banking
So
when we
I
feel
think
it's cyclical?
the best
Yeah.
answer to it is one should look at HDFC Bank, which has been, the top holding of almost all fund managers in India and globally if they were to invest in India. And this is one company which has been a part of a cyclical industry and yes, yet shown secular compounding of profit, of profit growth for like a good, not just 1 or 2 years, but a very strong 20 years. You have another company, let's say Bajaj Finance, which has shown you that despite being in a cyclical sector, it can compound at, let's say, upwards of 25-30% for a very long period of time. So while it is a cyclical sector, there are companies which would create business models which would make it structural, where they would be impacted by the cycle relatively less versus the peers. And you also have to also appreciate that, we are talking about, let's say, when we say cycles, we are talking about a 5-7 year period. So it is best to look at the performance of these things over a cycle instead of looking at, let's say, on an annual basis. In the Indian context, as I already discussed, besides banks, now you have other parts of the market. So I gave that example, like last year, in the first half of last year, banking was very weak, whereas capital market was doing very well. And then when, capital markets almost took a beating in the last 6 months, when the markets cracked, banking basically did well. So on a consistent basis, the overall sectors delivered more than 20% returns in the last 1 year. The sector's returns have been 26%, to be precise. So point is that, there would be these multiple pieces within the sector itself, where different industries would probably at various points in time. And a bank is, a capital market player is not affected by the same cycle as bank is. So monetary policy will not affect a capital market player as much as it would affect a bank. So now banking sector is broad-based in India. It's no longer just banks, right? So, yeah.
Sure. Somebody wanted to know your thoughts on IBC and the bankruptcy law. Is it still very effective? In past we have seen, when the steel companies are into problem and the infrastructure power companies. What is your view on the bankruptcy? And second related question is your thoughts on leverage. How leverage impact the performance in this sector? Role of leverage, basically.
Sure. So I'll first probably talk about the IBPC and, so when I was talking about, let's say, this second set of reforms that happened in India, starting from 2016, the DeMon, DeMon and GST were, let's say, two, important regulations or two important events. And besides that, there was RERA, which is again, let's say, not only had a very positive impact on real estate, but we have to understand that real estate is also one of the large credit consuming segments of the market. So, it indirectly benefited, let's say, the entire housing, mortgage, construction side of things on the lending. And then there was IBPC, which has been again a huge success in India. And now I think there is a recent development which is now questioning the efficacy of it, because Supreme Court has challenged, let's say, one of the resolutions. So that is, and government is probably taking a stay. So we'll have to see how this whole thing evolves. But what we gather from, let's say, our conversations from with the industry again is that this has clearly been hugely beneficial. We are seeing a lot of those resolutions, all those assets which were stranded. These were hardcore physical assets, which, the country definitely needed. And finally, these have changed ownership, and these are finally, let's say, coming to use. So this is only by virtue of this IBPC. So overall, I think the experience has been that it has been a great success in India. And what we've picked from, let's say, the corporate lenders, the banks which are heavy on the corporate side, they obviously feel that the environment of lending now is very different from how it was prior to IBPC. And the experience as an economy that we had between the 2015 to 17 period, where we had huge corporate NPAs, there is a strong hope that with IBPC, there will be a behavioral change in, the way promoters, let's say, run these businesses, because now there is a fear that people know that it is a possibility that they can completely lose their asset. And this framework would give a lot of comfort to lenders to lend to, let's say, the corporate sector. The private capex is not reviving in the manner that one would want in India. That is one of the areas which one is keenly watching for. But clearly, there is a lot of confidence that the next corporate cycle will not be the same as what we saw, let's say, in 2015. And I didn't quite follow the question on leverage.
There was just one statement somebody written your views on leverage. I think maybe you showed one slide whereby you were comparing a PSU bank and a private bank, and
Yeah,
PSU bank because of leverage, their other ratios get worsen,
yeah,
right? Despite the price to book value may be very
yeah.
cheap. How does leverage impact a PSU bank?
Yeah. So I will probably cover it on three aspects because I don't know what the objective of the question was. If it is what Nitin said, so obviously, as I explained, leverage indicates what is the kind of debt or external borrowing that you carry for every 1 rupee of, let's say, equity that you have. So higher the leverage, higher is the risk. To give you an example, microfinance companies actually had an experience of very large credit losses. Some of the companies actually had, and the credit cost went up to as high as more than 10%, 10, 12%. What it effectively means is that if that microfinance company would have, for example, had 10 rupees of equity and it would have taken 90 rupees of debt, then in 1 year, when it would have had such a huge loss in its book, 10% of, let's say, the borrowers have defaulted, then that company would have gone bankrupt. The entire equity would have gotten wiped off. And that is the reason why in India, microfinance companies are not allowed to have a leverage of more than 5 times, which means that they can have 20 rupees of equity and, let's say, 80 rupees of debt. That is the kind of leverage that is allowed. So with 10 rupees of loss, they were still left with another 10 rupees of equity. But if had they been allowed, let's say, a higher leverage, almost 10 times, then that company would have gotten bankrupt. So that is the importance of leverage. And hence, lower the leverage, less risky would be the entity. And the second point, if your leverage question is that what is the situation of leverage in the economy? As I said, corporate India is still very under leveraged. And all the banks, everybody is waiting for the private capex to start in a big way in India. And many of these companies have done IPOs, QIPs, and raised a lot of equity money. So they actually are sitting with low levels of debt and they are very comfortable. And if your third, probably the aspect is on a personal leverage, let's say Indian population, what is the kind of leverage we are talking about? So definitely our household savings have been structurally coming down. And at an individual level, because of the demographic change, youngsters tend to borrow a little more. So leverage is increasing in the economy, but we are nowhere in any kind of a dangerous territory. Leverage versus our own historical past has increased at a household level, but it is still in very manageable, levels.
There is one question which you answered in a way, but I'll just take and then I'll give you my views also. How is the fund different from Kotak, DSP, HDFC, ICICI? So generally, we don't, discuss comparison between one and the other. But broadly, if you see, you will find that, as Trupti mentioned, there is a six-member team. So research is pretty wide over here. A lot of people who are doing research on the banking financial sector. We have around 24-25% exposure to mid and small. And as Trupti mentioned, 20-25 names would be quite unique to WhiteOak. And the number of names in BFSI sector, this fund is also pretty large as compared to the others. That's a brief answer I'll give here. Trupti, two more questions. I think they are the last one. One is your view on PSU banks and small private banks, including small finance banks. What do you feel the future in these small private banks and SFBs and PSUs?
Yeah. So see, the PSUs, the way I would think about it is that, they have actually made a lot of changes. They have upgraded their technology, let's say, improved their systems and processes. We have interacted with some of the software companies which actually provide software to these banking, companies. And we have heard that in the last 2, 3 years, majority of the orders that they got were from PSUs. So clearly PSUs have upgraded the system. What we picked from the private banks is that earlier it used to be a cakewalk to take away business from private PSUs, because many of the PSUs were under something called a PCA. That is that they were not allowed to do business after the NPA issue. So all the PCA and all of that got lifted. And now PSUs are also given a mandate that, they are supposed to be service oriented and those kind of things. So private banks clearly say that it is not the same as it used to be in the yesteryears when it was a lot easier to take business from them. Having said that, see, they have, it's something like, if I were to give an example, if a child, let's say if there is a student and the passing mark is 40, and if the child was at 20, then maybe they would have come at to get the passing marks. But the question is that have they become, let's say, toppers in the class? The answer is clearly a no. So they have become better from where they were, but we still think that the kind of cutting edge work that the private sector is doing and the kind of alignment of incentives that the private sector banks have with the largest, let's say, the most important stakeholder, which is the shareholder, I think that alignment is a lot more in private banks. And hence, the PSU performance in the last year was very strong because it was actually reflective of that cycle. So somebody was commenting like banking is a cyclical business. So that cycle, that cyclicality part was visible in the PSUs. The private banks, in my opinion, are a more structural story. And the question on, let's say, the smaller banks, the SFBs and the other private banks. So clearly, see, the SFBs, I won't call them a great success so far in India, because their regulations actually are, a little more onerous. And what we also understand, because now these SFBs have been operating for a decade in India, so we have enough experience and, understanding of how their experience has been. They say that in the normal public, in like ordinary people's mind, SFB, the moment they see the word small, they just feel it is like a variant of a cooperative bank or something. So there are trust issues when these banks go and try to garner deposits. So there is, some kind of a disadvantage they have when they carry that word SFB in their name. Having said that, there are a few SFBs which have done very well. We also own, one of them in the fund. And the future of these banks could be that they will run as SFBs, prove themselves, and then apply for a universal banking license. So now the RBI has come up with this scheme where, after seeing your track record, if RBI is satisfied with the way you have worked, they can give you a universal banking license, which will put you on par with the other banks. So that is the journey that these banks have to see. And in that process, they should not die. So one is looking for those kind of companies, and I think there will clearly be some winners that will come out of the pack. One company clearly is looking like uh, one of those. So that's on SFBs. Yeah. And other
Yeah.
smaller banks, I think it's case to case basis. There's a lot of opportunities, so we need to evaluate them. And yeah, they could definitely be investable at some
Sure.
point.
Sure. Your example of SFB reminded me, जब टाटा ने नैनो लॉन्च किया था तो लोगों ने इसलिए नहीं खरीदा बिकॉज इट वाज लाइक अ ऑप्शन
Um,
अगेंस्ट टू व्हीलर, कि भाई
correct,
मैं बड़े बैंक में अकाउंट खोलूंगा ना, मैं स्मॉल फाइनेंस
correct,
बैंक क्यों यूज करूँ. सो
correct, correct.
there's one last question, Trupti, which is
Hmm.
little thought provoking, I say. What happens when the sector weightages come down in Nifty? Like IT was at a higher weightage, and over a period of time, it has gone down. Do you foresee such thing happening in BFSI? And if then, how do we deal with it?
So I'm glad that somebody asked this question because it just gives me an opportunity to touch upon, let's say, one of the, philosophies that we follow at WhiteOak. So see, the way we think about it is that, we actually don't take a view, we don't take any top-down view, we don't take any sectoral views, we don't really construct our portfolio based on index weights. So we don't, our portfolio construction is not, the process is not that, we look at that banking is 30% in the index, so we need to have a 30% weight, or pharma is about 8-9%, so we need to have, let's say, 10% weight. That's not how we construct our portfolio. We are a sector agnostic, market cap agnostic firm. And I think what we are clearly looking at is outperforming the index. So what we do is that, our portfolio construction is based on bottom-up stock selection. And at any point in time, the firm has, let's say, 300 to 400 companies that we are actively looking at. It's a very large team. almost 32-member team, which is looking at all these companies which are assigned to them on sectoral basis. And from there, we identify the companies where we see the highest upside, and then we create a portfolio. And then once the portfolio is constructed by bottom-up stock selection, the portfolio manager is looking at what is, let's say, the comparison or the deviation of this portfolio versus the benchmark on sectoral basis, on market cap basis. And then if there are, let's say, by way of this stock selection, we've created huge imbalances in the portfolio, then we try to balance it and create a balanced portfolio. To just explain it in more simpler terms, if, let's say, by way of stock selection, if we have created a portfolio where we have created a huge underweight or an overweight in a sector. So if banking is 30%, but let's say we've created a 40% or a 45% weight in banking and financial services, then we would, let's say, decide that what is the level of underweight or overweight that we are okay to tolerate. And then we would cut down, let's say, from that 45, and we would bring it to a level which is more acceptable to us. So if, let's say, a few years in the future, if banking as a sector, let's say, would come down, I mean, our portfolio decisions or our stock selection will not be driven by that. We would still select names, again, run this process and see what is the kind of overweight or underweight we are running, and then, balance the portfolio. So we, at any point in time, we want the portfolio to have a very balanced, let's say, it has to be very balanced. It should not have any huge factor risks. And only by virtue of this, one can achieve, let's say, consistency in performance. Otherwise, as most of you would know, that every time in the market, there would be some sectors which would do very well, or there would be some particular market cap which would do very well versus the others. So if your portfolio at that time carries that overweight, then obviously you would have a pleasant experience and vice versa. So to avoid that, we avoid large overweights and underweight, both to market capitalizations and sectors. Having said that, we particularly have a little more bias towards mid-cap sectors for the reasons that I explained, that these companies we think are under-researched, and these would generate higher alpha.
Sure, Trupti. I would just like to add in this only. For example, there are other sectors also, let's say a pharma, which is a 7-8% on in the benchmark. But still we also have a pharma dedicated fund, because again, the theme is not about pharmaceutical companies. The theme is pharma, diagnostic lab, hospital chains, chemical. So similarly, banking, even if the percentage goes down, the theme is pretty big. So there would be a lot of opportunities, for a active smart fund manager to get on a number of stocks which can create alpha for the investors, right? Trupti, more or less, we have answered all questions. Uh, with any parting note you have to say in view of the current circumstances, though war looks like more or less over, but you never know. So any thoughts you have how people should manage portfolios in general?
Yeah. So, see, obviously, banking as a sector would get impacted with external events, a lot of macro events, be it, let's say, the geopolitical tensions, not only in India, but let's say maybe other parts of the world. It could be, let's say, the interest rate cycle in the US and so on and so forth, because it is a sector which touches every aspect of the economy. And there would be second order, third order impacts, which probably we cannot, let's say, comprehend at the first go. So obviously these sectors, these companies are high beta companies. They tend to react, more than, let's say, the market. Having said that, we strongly believe that it is a heterogeneous sector, and there are a lot of, at the cost of repeating, there are a lot of variety of businesses, which makes it an extremely attractive sector for an active fund manager to identify opportunities which will do well in every context. And as somebody pointed out, while it appears like a cyclical sector, but the art would be to find companies which are structural bets, which would be less insulated. I won't say completely immune, but would be less impacted by external events. And most of these businesses, be it lending or insurance or, let's say, capital markets, most of these are domestic. These are all inward facing. And hence, unlike sectors like an IT or pharmaceuticals, etc., which are, let's say, a lot more export oriented, this is a sector which is completely domestic driven. So in this particular context, if you ask me, then let's say if global macro is a concern, then obviously this is an extremely attractive opportunity. I just want to reiterate that it has a very long term bright future in India and is available to you at reasonable valuations. That is an important part, and hence I think this is an extremely attractive entry point. Even though in the last 6 months it has outperformed, yet uh, even after that outperformance, we still think that there is still a lot of potential in valuations. So I think it is an extremely opportune time.
Thank you, Trupti. Thank you so much for taking our time, and thank you everyone for joining us. And we'll see you again with a different sector analyst next time. Till then, take care. Thank you so
Thank
much.
you. Thank you so much for being such a lovely audience. Thank you. Bye.
Bye.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.